Hey guys, how you doing? Hope you're having a wonderful week end. And today we're gonna do same thing we do practically almost every week. We analyze the market. Now, if you're new to the channel, you might need to, go back and watch previous videos because this session is gonna be quite short and straight to the point for the guys that have been here before. So let's get right through it. So for the guys that have been here before, I've already done a pre-analysis, not the entire thing, but maybe a few, assets that you can look into. Now, this is not a trading signal. Please consult with your own personal professional, trading specialist or investing specialist. I'm just showing my own way of looking at the market, and I'm displaying these tools for you to see how to look at the market from an alternative perspective, right? These tools do give you an advantage, but I'm not telling you, to use them. I'm just saying I've noticed it's giving me an advantage. Now, that being said, let's get right to it. So the tools that we're going to be using three different tools today. One is called COT, which is Commitment of Traders Report. This is available to everyone around the world, based on United States Freedom of Information Act. So this is to help avoid market manipulation and all of that stuff. And it looks something like let's see how it loads up. It basically is just a chart that shows you how many positions have been added to the long and the short side of a specific asset. And the people that are involved are categorized as commercials, non-commercials, and non-reportables. So commercials are people in the industry that use it for their normal business activity. If you're a company that wants to buy, you know, material in China, you might need Chinese, yuan, for example, and then yuan, and you might, want to trade your dollars for that, or your pounds for that, or your euros for that. And you're not necessarily making money off that exchange rate or that exchange of currencies that's going on. You're just trying to get the currency of that other country. So those guys are classified as commercials, and non-commercials are people like you and I that trade the market and make money from the movement. So what we look at is we look at commercials. We just follow these guys. They're not looking at interest of making money from the market, which makes their bias clean. They're not like, oh, okay, I need to make money from this. They don't care about that. So their bias is clean, and they always try to get the best price. These guys are actually very, very, very good at mapping out where the price is going to be. I don't know how they do it, but I just know they do it. So we just want to piggyback off that information. So thank you, United States, for giving us this information. And what we look at is commercials, if they're going short or if they're going long. And we look at the changes. That's all. We don't look at these big figures right here. We don't care about that. We'll look at the changes and we'll look if they're going short or they're going long, right? So we go changes, commercial, short. Short means sell, long means buy, okay? But the guys are new. So what we know now is gold. They're going short. That's good. Now, you don't just go into the market and just dive into gold because of you seeing gold going short on that. What you tend to do is you want to stack up the odds in your favor. Then the next thing we'll do is look at seasonality. Now, seasonality is basically what the name says it is. It's about a season. So there's 4 seasons: winter, autumn, summer, and spring. I'm in Nigeria right now. I don't know how many seasons they have. I think they have Hamatan, which we're getting into now. I don't know if that's a season, by the way. I think they have the sunny and the rainy season, and I don't know if there's any more. So, but yeah, you get the point. Now, every market has its own way of moving in every season. The market season is quite simple: Q1, Q2, Q3, Q4. Now, what we tend to want to do is we want to look at which Q we are in, which quarter of the market we're in, and how is the market normally responding within that quarter, right? And then if that is in alignment with the COT report, we take that trade, right? Quite simple, right? But we still have another tool to look at before we take the trade. We just don't jump into it. So, right, we are on the third, right here. So if we look at it for gold, let me just zoom in a little bit. So if we look at this, where we are here right now on the third, right? Third right here. So what we're seeing is we only take trades when all three are aligned, right? When the three of them are pointing towards the same direction. And currently right now, they seem to be pointing towards the same direction because we're right here on the third. Now it's pointing down So maybe about the 5th. And then the 47 years, the yellow, which is 47 years, is now pointing back up. So what you're seeing right here is the 5, 15, and the 47 years average price movement. So in the past 47 years, past 47 years, the yellow is how prices moved during this period, right? So what we're doing here is we're looking like at all three if they are aligned. And when they are aligned, we take that trade. Now, I like it to be aligned more than 1, 2, 3 days. I like a whole week or more. But this is like 3 days, then market might start acting up. But overall, it looks like it's bottoming out. So this is already a high risk trade if I trade it short. Now, COT is saying short and seasonality is saying short, then most likely gold is going to go short. But this short is not that clean. So it's a high risk one. Now, to confirm this and say, okay, it's telling us to go short. Ideally, the move should have started from the 2nd, which is yesterday, was Saturday. And now we're in 3rd. Market will open today. You want to know, am I too late? So this is where the 3rd tool comes in. You go ahead and check probability. Now, if you want to get this tool, you can go to the website business.demempire.co.uk right here. Right there, right? So that's where you go to. And then just click on the pricing section and it should take you to how to get the tools, right? Let's wait for probability to load so I can show you what it looks like, and we can use that to see what gold is really saying. So this is what a probability looks like. We designed this in-house by ourselves. The idea is not originally ours, but we designed the entire tool ourselves. So we know that it's short, that gold is going to go. So we're going to come here on probability. And probability now, we go to the date, which is tomorrow is 4th. Today is the 3rd, which is Saturday, right here. You can see it. December, Saturday, no, Sunday. Sunday right here. Saturday, Sunday, not applicable. So what we're looking at is if it's buy or sell. So what we can see is we have a 61% chance on the Monday to sell gold. So if we sell on Monday, we have a 61% chance that trade is going to be our favor, then 57. Now, I like it to have 3 days in my favor, not just 2. So because we only have 2 days, but everything else seems to be aligned, except the seasonality as well is shaky. What tends to happen is this is a high risk trade, right? But it's still good to trade. So you write it down as a trade and that's it. So for time saving sake, I've done some analysis and these are my analysis, right? So you got gold going short on the 5th. Now, these are no signals, guys. These are no signals. These are my own personal outlook for the market. Remember, I do have an EA. I just plug these things in. I forget about it. I come back on Friday and check it, or I check it during the week or when my exit date is meant to be. All right. So this is no signals for you. You should make your own bias, do your own, analysis and everything. This is for educational use only. So seasonality, based on my apologies, based on my analysis, this is what I've come up with. So I have these assets. I got gold, AUD USD, Euro AUD, and AUD CHF. Now remember, we're still in one of the AUD, I think AUD CAD, which we still have a little bit of profit, not that much, maybe just like £100 or so. We'll take that because exit date is today, right? So concluding last week's trade. And yeah, we completed the weeks before last week's trade last week, and we completed last week's trade. We'll be completing it tonight. So closing that, hopefully it doesn't gap too much. And if it gaps late, let's it gap in our favor more so we can make a little bit more money. But I'm closing that trade. That way we still made profit last week. Now, this is this week's selection. Some of it, there's a lot more assets that actually aligned. I haven't had time to go through all of the assets, but these are the ones that are good. And you can see short term as a medium risk. So trading from 3rd to 5th, that's 2 days. In this one, you even have a situation you just have to trade a day, short term. But the long-term move is really the move, You have to wait till, like, for example, the gold exit is on the 14th, AUD exit on the 20th, and the rest, on the 20th. So that's it, guys. Remember, at the end of the year, liquidity is also sometimes low, because a lot of people are wrapping up their trades and their trading portfolios and all of that. But so far, so good. We've been making some good results. Percentage, I think my account is up, yeah, close to 10%. So that's good. And when I say 10%, I think that's about in the last month. It's not the entire year. I know the average return on investment for hedge funds, also ranges around the same figure. But yeah, that's it, guys. All right, take care and have a lovely trading week ahead. Catch you and trade safe. Stay dangerous, man.